And this is just a follow-up. We had a webinar earlier on, we've got new information on the CARES Act and Paycheck Protection Act. So along with me today is Mike Weaver, Jim Piper, and Alex Rainville, who are all participating in our consultations on this issue. So we've got some applications or proposed applications out as of yesterday on the big issue of the week, the Paycheck Protection Program. We are going to try and cover that as well as some of the other questions that are coming up from participants. So the first thing, Jim, I'm going to ask you is just, how does somebody know if their business is eligible to apply for the Paycheck Protection Program?
Well, generally it's designed for small employers, and the sort of the bright line test is 500, but there's some give and take there. 500 employees, and the 500 employees for purposes of eligibility is head count. So part-time, full-time count the same for that initial test. There are some exceptions though. And for one thing, if the Small Business Administration qualifies you as a small business concern, even if you have more than 500 employees, you are eligible. And then there's some breakdown for specific types of businesses that are affiliated generally, but are not affiliated for purposes of the PPP loan. I think maybe Alex has some additional information on how that works.
Do you have some examples, Alex?
Yeah.
You know, we don't have you on video yet, but that's okay.
Yeah, absolutely. Yeah, so the CARES Act specifically carves out certain or makes certain exemptions for different types of businesses. Obviously, the intent is to protect some of the hardest hit industries, including those in the restaurant and accommodation
Well, can you
industries.
just explain to me what you mean that they make an exception? So there's some industries that if they have more than 500 employees, then they can still apply for this loan. Is that what you're saying?
Yeah, yeah, kind of. So the intent really is that they carve out specific businesses more so than having more than 500. So rather than affiliating, by way of example, if you own 3 hotel chains and together that's more than 500 employees, ordinarily under those affiliation rules, you would not be eligible for these loans. But the CARES Act specifically carved out an exception there, so each property would be counted separately. So if you have 3 hotels and each underlying property only has 200 employees, you would qualify and you could apply on a property-by-property basis. Another example of how this applies is if someone owns one individual person or one business owns 4 underlying companies, and 2 of them are, you know, by way of example, a clothing store, and one of them's an advertising company, and one of them's a restaurant, and collectively you would end up being over 500 employees. But if you take out the restaurant, you would fall under 500 for the companies that still have to be affiliated. You could apply because the CARES Act, again, carves out that restaurant. So the restaurant would be counted separately.
Let me ask a question in that example. So let's say I'm the owner of those 3 different businesses. So basically what we're saying is that the SBA has affiliation rules, and I think we posted the link to that guide on our COVID website so that employers can go out and look at that particular guide. There's a lot of good guidance in there to tell you. But as a generality, if one or 2 or 3, a small group of people own several different businesses, even though they're different types of businesses, then those are going to be usually affiliated under the SBA rules. And we're going to look at the head count for their employees across all those businesses, even though those businesses are different. So they're looking at control and ownership, and there's no like separate line of business rules in this instance. But what they've done in the CARES Act is carve out and say, okay, if you own these 3 different businesses, and basically for all other purposes, you would be affiliated under the CARES Act generally. If one of those 3 businesses is a restaurant and that's been required to close down, you can apply, you're in one of these categories, you can apply like your own deal even if the overall affiliated group would generally be over 500, correct?
That's correct.
Okay, now let me ask a second question. So let's say I'm the owner of those 3 businesses. Now my restaurant is under 500, but I have these 2 other businesses, the advertising company, and what was our other one we were throwing in there? A dry cleaning.
Just a clothing retail
whatever.
store.
So I own 2 other businesses. Are those 2 other businesses affiliated, but if they're under 500? So let's say all 3 businesses are over 500 employees, but now I pull out the restaurant's under 500, and by taking the restaurant out, my other 2 companies are under 500. Can both the restaurant and my other affiliated group apply?
They would be eligible, correct.
So I can basically apply for 2 PPP loans on that calculation, correct?
That's correct, yeah. So you just want to make sure that the affiliated companies are counted together, and then go ahead and pull out those companies that are exempted or carved out through the CARES Act.
Now, we're getting a lot of calls from employers that are over 500 who, for the leave rules that came out in the Families First Act would like to be over 500, and for this act would like to be under 500, right? And so the thing there is a lot of other relief for the over 500 employer, and in some cases it's a different set of rules. So it is possible to be over 500 for one set of rules and under 500, and this is probably really a Jim question, but under 500 for these rules, right, Jim?
Yeah, technically the family leave is under the Medical and Family Leave Act, FMLA, and that has a slightly different test than the Small Business Administration for determining how you affiliate and combine, different groups of employers who are part of an affiliated group or controlled group. So there are some different tests for purposes of the paid leave as opposed to the loan programs under the Small Business Administration. So yeah, it is worth it to take some time to figure out, where you fit under, especially if you're fairly close to 500 employees, to fit how these different tests apply in different contexts.
But if you're under 500, this is a non-issue and you're eligible to apply, right? So then it's our understanding that the application is out, or there's at least a proposed application, correct? And it's my understanding some banks are already providing those applications and requesting information, but they can't actually submit them until tomorrow. Can you speak, is that Jim, you're speaking to this one a little bit?
Yeah, the guidance from the Treasury said it was a proposed application. I don't know that the banks are required to use that exact form, but I assume most of them will. And this particular application is going, unlike the disaster loans, the paycheck loans are coming through financial institutions. So you will work with a bank, an authorized lender under the SBA. And most people are advised to start with your usual bank or financial institution and see if they're one of the partners.
So the sample form, and what I'm hearing this morning is that some banks are sending out forms that are different from the sample form that was published yesterday, and that's totally acceptable. So that's why it's important for anybody that's wanting to apply to get into touch with their lender, probably a lender that you regularly use if you don't ever take loans out, and just contact whoever you do some banking with, and that would be who you should work with. So let's go to talking about that sort of several $1 million question is, can you get both a disaster loan and the paycheck loan? And that's a simple answer of yes, right? Before we qualify it, you can in fact apply for both loans. The biggest thing here is that you can't apply for the same, you can't finance both expenses twice. So do you want to talk a little bit, Jim, about the kind of loan combination thing, like should you apply for both loans?
Yeah, I think based on the guidance that came out this week, they're anticipating a very high demand for the PPP loans. They used that language 2 or 3 times in the materials that came out. So they're really trying to focus that on the 8 weeks of payroll. And so that loan that you're getting through the lender through the PPP is intended to mostly cover, the payroll for those 8 weeks. So if you have, expenses other than that you need to get financial assistance for, or if you need that immediate $10,000, which is supposedly available through the disaster loans, you would want to go down both paths. If you really only need the 8 weeks of the payroll, then you can just do it through the PPP program. But as long as you're not financing the same costs in both loans, you can go down both tracks.
And what we did yesterday was go through, well, who should apply for, like originally we were advising, there's some employers, because of the way this test works, that our suggestion was, well, you should wait to apply because you're going to get the most forgiveness under the PPP if you apply close to when you can hire people back. And there's this test that says you have to pay, to the extent you take this loan, if you want it to be forgivable, you have to use 75% of the loan. This is the PPP loan, the PPP loan, for payroll. And so if you've laid everybody off because you're closed and you have no job really to give them right now, we were saying, well, look at applying May 1, which would still make logical sense, but the problem is the concern is funds availability, correct?
Yeah, the materials that have come out from the people that put the bill together said they authorized $350 billion for this program, and they based that on 6 weeks of payroll costs for all small businesses in the U.S. So their assumption was that not everyone was going to apply and not everyone was going to use the full 8 weeks of forgivability. And apparently, since then they've seen that maybe the demand is going to be higher than that, and they are worried that it might not be enough to cover the entire amount that's applied for. And so the language they were putting out is, you might not want to wait because the money might run out. So yes, I think we were thinking to try to calibrate sort of the 8 weeks so that at the end of the 8 weeks, you might be able to be back up and running, especially on the personal services, businesses that require, personal contact with the clients, customers. But that might not be as important now as just making sure that you get in and get the loan before the money runs out. So we'll have to wait and see on that, but I don't think it's going to make sense to do that strategically waiting that we were talking about previously.
But yeah, the reason to wait, and so in some cases where we're at is, hey, if you're shut down, so the hardship loan, that gets the hardship disaster loan, you get like 30 years to repay that, correct?
Yeah, it can go up to 30 years, and it's 3.75 interest rate on that for small businesses. And there is a deferral period of at least 6 months, and it can also be extended. So yeah, if you have just trying to survive and not worry about the payroll forgivability, then that disaster loan will make a lot of sense. But that is limited to $2 million, whereas the Paycheck Protection Loan can go up to 10. So.
And that's where what we've been talking about. So we ran through several of the examples based on what we've been asked yesterday, and it continues to be the answer for everyone. So this webinar, we're given generalities, but we're doing flat fee consults to really try and help clients know, should you get the hardship, should you get the PPP, should you get both? And but we are going to give a couple examples in terms of how. But so as a generality, there's potentially an advantage to wait to apply. But the concern is if you wait to apply, there may not be the funds available under the PPP. And so that's just a consideration. But if you take the PPP and then you cannot, it's not forgiven, you have to repay it over 2 years, whereas the hardship loan, you have 30 years to repay, correct? So that's kind of the challenge that you have to consider. So if you've got everybody laid off, and part of that, I just want to make sure that, because we've had differing information on this, but what we know now is that you have to spend, so the day you get funded with your PPP, you have 8 weeks from that date to use 75% of that towards payroll. So if it's very unlikely that you're going to be able to rehire a good chunk of your employees in 8 weeks, then you're looking at the possibility that that loan won't be forgivable. On the other hand, as Jim pointed out, you can get more under the PP program, and your worst case scenario is that you have to repay some or all of that loan, correct? So let's just talk about how much you can get for that loan and how you do the calculation. So we did this with several hypotheticals yesterday in terms of, one, how much can you get and what's it going to take to spend 75% of that on payroll? So can we run through just that calculation?
Yeah, the starting point for the calculation is the defined term payroll costs, which basically is compensation, but also includes health and retirement benefits. But it is capped at $100,000 per employee. So basically, you can add up your average payroll and divide by 12, but then you have to subtract out any payroll for anyone over 100,000.
So just to oversimplify it, if I had one employee who makes $100,000, but we also gets benefits, and your retirement plan and health insurance, we don't get to include those amounts as part of the payroll costs for that employee.
Right. You would just anything over 100,000, you just count it as 100,000. And then you multiply that by 2.5. So here's the example. You have a CEO that makes 150, so you just count that as 100. So you eliminate that other 50. Then you take the 12 months.
I think we were going to let Mike run through this example, weren't we? Is that going to be Mike?
Sure, I can.
I'm sorry, that was
Mike,
kind of me running you guys together, but I'll let Mike run through this math on this one.
Sure.
Yeah. So again, using the example, if you have a total payroll of $1,250,000, but the CEO is making 150, so he or she is $50,000 over the $100 cap. So you would take your payroll for the 12 months and reduce it by the 50,000. So in this example, the $1,250,000 is reduced to $1,200,000. So that's your trailing 12 months payroll. So you divide that by 12 to get your average monthly payroll cost. In this case, it's $100,000. So then you take your 2.5 amount, you multiply that by the 100,000. So your total PPP loan in this case would be the 100,000 times 2.5, which is the 250. In addition to the 250, if there are some expenses that you would want to have paid, some forgivable expenses that you've either previously paid or you want to have paid through a disaster loan, you can roll part of the disaster loan into the PPP. So it would be the 250 plus whatever you might roll of the disaster loan into the PPP. And we're going to go through a couple of examples on when it might make sense to do that.
But it's not a lot, right, Mike?
No.
Because if you think about that 75%, right, when you get to the forgiveness, kind of we're like, well, if you have some really weird, unique costs. So we were, kind of the question we were asking ourselves when we were running through the math yesterday is it really going to ever make sense for somebody to roll part of the hardship disaster loan into the PPP? The sort of generic answer we came up with is not very often unless you have some really weird, kind of a weird scenario, right?
Right. The requirement that 75% of the PPP be used on the payroll does does limit what amount of the disaster loan that you can put in there. And again, when you run the numbers and you look at some of the forgivable expenses, yeah, it's kind of it'd be weird situations where where you'd have those other expenses that would be forgivable to a sufficient amount where you might want to roll some of the disaster loan in. Now, there may be those situations, but when we get to the example, I mean, you know, if you're talking rent and mortgage interest, you know, how much of that are you going to be paying over 8 weeks? That's going to be able to use up part of that that additional 25%, if you will.
And so we originally, when we started talking about this and earlier in the week, it was sort of like no brainer, everybody should apply. And as we've played with this number, there's still some sense to that conclusion, but there's a little bit of thought that ought to go into it. And so part of that is like just before you apply and get the maximum amount and roll the hardship loan in thinking it's going to be forgiven. And the next part of the conversation is really, how does this get forgiven, right?
Yeah, you do want to be careful because obviously anything that you're rolling in from the DL, the disaster loan, you're moving from a 30-year payment to potentially a 30-year repayment to potentially a 2-year repayment if it's not something that can be forgiven.
So how does the loan get forgiven? And again, originally we were sort of saying, well, let's just get everybody the money and we'll worry about that later. But we've now concluded that you have to give a little thought to how it's going to be forgiven to decide what makes sense in terms of which loan programs to get involved in. So how does that forgiveness get calculated? Does that go back to Jim or who's doing that one?
Jim, you want to take that?
Sure.
With the...
So there are the 3 stages here, as it says on the slide. So first it looks at what you actually used the money for, and there are 4 categories that are allowed. And they did narrow that a bit in the guidance yesterday. There's some areas of the statute that are permitted that now Treasury is narrowing it down just to these 4 categories. And that's that defined term payroll costs, which you have to understand is limited to $100,000 per person. So you're not going to get forgiveness if you're paying someone more than $100,000 annualized, only up to that cap. Interest on a mortgage that was entered into before February 15th.
I just want to ask a question on that, Jim, because that's different from what we were asked earlier in the week and what we knew. So originally, we thought our understanding was the calculation was capped on $100,000 per person, but you could pay them more and still have forgiveness. But that's not correct. Both the calculation and the forgiveness is capped at $100,000 for anyone, correct? You can pay them more than that, but it's not going to be forgiven as part of this loan.
Yeah, I think the forgiveness was always capped, but it used to be allowable to take some of your loan amount and pay someone the higher compensation. But now they've narrowed it down and said you can't even use the loan amount for that higher amount.
So yeah, so it's not a matter of forgiveness, it's just a matter you can't use these loan proceeds to pay somebody. Now, but if you have other revenues from the business, so you're for a partially operating business, you can pay somebody more than $100,000, correct? It just can't be part of the loan proceeds. Not sure how you track all that, but you need to have some accounting function to show the use. You're going to want to have some accounting that shows this is how we use this loan.
Yeah.
And particularly in the 8-week period after receiving it. Okay, did you finish on those ratios? Yeah,
you want to show that you've used the 4 categories, payroll cost, which has to be 75% now, and then the other 25% can be used for mortgage interest on an allowable mortgage, rent on an allowable lease, which means it was entered into before February 15th, and then the basic utilities, and that again goes into the 25%. And then that's adjusted by looking at this ratio of how many full-time equivalent employees you had during the 8 weeks to how many FTEs you had during the defined base period, and that's defined in the statute. Basically, if you're keeping everybody on staff, then your ratio will be 1. If you're laying everybody off, your ratio will be 0. And if it's a mix, then you'll be somewhere in between. And that'll be multiplied by your expected amount. And then if you've reduced someone's salary a bunch, then that'll be additionally subtracted from the forgivability. And we got examples just so that we don't have to walk through this in abstract. But
Can I, before you go into the example, I'm just gonna ask a couple questions that have popped in. So one is newly formed company with 2 owners and no other employees. They just started generating income in the last 2 months. We've been affected because our clients are slashing their marketing budgets and they're in a marketing type business. So they now have no work. Do they qualify for the PPP or the hardship loan? And isn't that depend on what date they started?
If they're in existence before February 15th, they are eligible, but their loan amount might be pretty small if they're, depending on their average monthly compensation payroll costs for the previous 12 months.
So for the PPP, now I thought there was a deal, I thought there was a rule where they could use payroll for this year if they're a new company.
Yes, they can use, I think, a shorter period earlier in 2020, but it will still depend on their average monthly payroll costs during that period. So
they'd also be eligible for the hardship disaster loan, but again, that's based on sort of 6 revenues, and we're seeing 6 months of expenses. So they could show that amount, so that might or might not be help them. They might be best served by doing the self-employed unemployment, correct? Those would be the 3 options to consider.
Yeah, if their business dried up because of COVID-related economic disruption and you're self-employed, then you can go under that, and that's a different area. But yeah, that's a possibility also.
So just another question regarding the 100,000 cap is when you talk about the retirement benefits being covered in the calculation, is that amount also capped for the 100,000, or are retirement benefits not capped for higher earners? And as I understand that, it's like if you have a high earner, basically we look at wages and benefits, and the total amount that can be included regardless of that for that high earner is 100,000. So if their compensation is over 100,000, they get to add 0 for the retirement benefits.
Yeah, I mean, the defined term is payroll costs. So you would add up everything that's defined as payroll costs, which is wages and benefits for health and retirement. And if that's over 100,000, then you just count it as 100,000.
Thank you. So then the forgiveness, the example, I don't know who is doing that one. Is that you?
I think these are probably mine.
Okay.
So these are based on where you're calculating this ratio. And the first example, if you just keep everyone on your payroll.
Can I do the Mary thing, which is like I try and oversimplify? And so at the end of the day, the forgiveness ratio is if you had 10 full-time employees before and 10 full-time employees after for during this 8-week period, right? Then it's 100% forgiveness. That's a super simple. Now, what if I have 10 employees, 10 full-time people before, and then I keep all 10, but I have them all work half-time? I believe, as I understand it, I now have 5 full-time equivalents. So my forgiveness ratio is 50%.
Yes, and if they're losing pay more than 25%, then that's also going to be deducted after the employment ratio.
I was doing the Mary, let's keep it super simple thing, which was, how I like to do that. So the super simple thing is if I have 10 full-time people before and 10 full-time people afterwards, and I make no pay adjustments whatsoever, then bottom line, my ratio is 1, my full loan is forgiven. If I have 10 full-time employees before, I keep all 10, but I have them all work half-time at half pay, I have 5 full-time equivalents, so I have a 50% forgiveness ratio.
Yes, generally that's how it works.
Okay, and then now you can complicate it.
Well, I mean, I think the PowerPoint's going to be available to everyone too, so people can work through how this works. But basically the key date for the ratio, April 27th. If you bring everyone back, that might be on the next slide, by April 27th, that's going to count as if you kept them on the whole time. So you won't lose the time between the day you apply and April 27th, as long as you bring people back. The second key date is June 30th. If you bring everyone back by June 30th, then you will lose some of the time for your ratio, but not all of it. So basically the way to keep the ratio close to 1 is to either bring everyone back soon or at least by June 30th, and then it will not be as much of a penalty as if you're keeping everyone laid off the entire time.
Okay, so then there's some additional examples of the forgiveness ratio.
Yeah, so this is some specifics. Again, bring everyone back by April 27th in example 2. You still keep it at 1. In example 3, you've got some people back and others people not back, and you can see you end up with a ratio 68%. So you're going to get mostly forgiven, but not all of it. And again, if you're having people not being paid and not employed for more than the 8-week period, then the ratio goes down and the forgiveness goes down. So example 4 is where you have basically what Mary you were talking about. You have half the people on and half off, or half time. You would get half of the loan would be forgivable. And then example 5 is, as I mentioned, if your salary, you have someone or more people who are salary reduced by more than 25%, that's going to also be subtracted from your forgivability amount.
So you could do a 20% pay reduction, because most people, almost all businesses are being impacted in revenues in a couple different ways, right? I had a call with one business yesterday who, hey, we're busy, but nobody's paying their bill, and they're all being told not to pay their bill. So, if you don't have the revenue coming in, then how do you pay people? And you have to look at what makes sense. But so you could make a 10% across the board pay adjustment, and it's not going to affect your forgiveness ratio. But if you do more than 25%, it will, correct?
That's correct, yeah. So you can do across the board, something like that, and it will not affect the ratio.
And so, I have a few questions so for the next question we have is that, oops, that one we already did. So if you are approved for $300,000, but after 8 weeks, you only use a total of $200,000, is the 75% cost based on the amount used?
The guidance on the 75% was pretty sketchy, but it just basically said that they anticipate that you would need to use 75% on payroll costs in order to be forgivable.
Right, but so I think the question, and it's a fair question that we might not know the answer to, is if you get a $300,000 loan, you use $200,000 of it, can you repay that $100,000 right away and then treat the $200,000 as your base for the 75% count? And we think the answer to that's no, correct? And that's why we're saying it makes a little sense to give some thought to how much you're applying for rather than just applying for the full amount. Because you do have the disaster loan availability as well. Is Mike a different thought on that? Did you have a different thought on that one, Mike?
No, I think that's right.
Okay, so what about LLC owners that don't pay themselves a formal salary in 2019? So if you're an LLC owner, and I think the answer to that, and Mike, I'm going to have you speak to that one. If it's a partnership, you would typically take guaranteed payments, and guaranteed payments would count in this calculation. But what if what if we had a profitable partnership and each of the partners was allocated 50,000 of income on their K1, but they didn't take any guaranteed payments?
Yeah, I don't think the guidance out there is real clear on this. You know, a guaranteed payment is more in line with a wage, if you will. It's sort of treated more like a wage. If you're not doing guaranteed payments and you're just taking a distribution out of a partnership, it's not real clear whether that would be counted as a wage that you could use the 2.5 times. You know, if you look at the intent of what this is designed to do, if you just aren't paying yourself, but you're taking that all into income, I mean, arguably that is your wage and that should be counted, but I don't know that we have an exact answer to that just yet.
Yeah, so there's not a clear answer. So, but what we're concerned with is, so both S corporations and partnerships, for various really good tax reasons in the S corporations, we like to pay S corporation distributions to reduce the Social Security tax costs, correct? And what we don't know for sure is whether those amounts are now included in payroll. So to the extent you make yourself S corporation distributions, I guess the bottom line on that, in applying, did you use that amount for purposes of applying? And we just have no clear guidance, but everybody wants to file their application tomorrow. And you can come back and think about that and answer that question, because we didn't discuss that one. And I'll ask this other one is, what about independent contractors? So if I'm a business who uses a lot of independent contractors, let's say I'm a general contractor in the construction industry, and I hire independent contractors who are other companies, versus a company who, you know, a massage studio who all of the employees are independent contractors, but it's a one-on-one relationship. That one-on-one relationship where I've hired independent contractors and I give a 1099 miss, those you can include in the calculation, correct?
Yeah, that's correct, and that is correct. You know, Jim and I were having a kind of a interesting conversation before we got on. Let's say you are that general contractor and you hire an electrical sub, and that sub has 5 guys working on your job site. And let's say that the amount that, and you use this guy pretty regularly, and let's say the amount you're paying that electrical sub is $50,000 a month. Well, you got $600,000 a year going to that electrical sub, but that's being used to pay 10 guys. Is what you pay to that sub limited by the 100, or can you look through that and look at the guys you're actually paying on the job site? I think, you know, again, there's no real.
So we are for some reason losing your mic.
Is that better?
Yeah, they got it.
Okay.
So the question though isn't like the easy answer that the subcontractor could apply for those employees if they're a company, and that would be clear that they could.
They could.
We haven't seen any guidance allowing us to apply on a flow-through basis for a company, correct?
That is correct, but it's really it's the guy that's hiring the subcontractor. He's the one that's actually making the payments, and he's the one that actually needs the money.
But so isn't the answer to that our contractor pays the sub? Yeah, I mean the subcontractor's paying the guys, he needs the money. That's what you're saying.
No. I'm saying the general needs the money because he's got to pay the sub, who then pays the workers.
Yeah, but the sub, my thought is the sub pays the workers. Our guy needs the money, but that he's getting a hardship loan. So, what about part-time contractors? Can they count those? And does it matter, I guess, if they're part-time, if they're occasional? So we have like regular part-time independent contractors. So a lot of places will hire, you know, a lot of hair salons, things like that, a lot of massage studios, fitness company. There's a lot of, you know, there's tons of them. We could come up with tons of companies who hire part-time contractors, can they use those in the payroll? And I believe the answer is as long as we're issuing them a 1099 MISC, it's clear that you can include them. Is there any limitation on if it's part-time occasional? Like I hire this person once only with no intention of ever using them again versus somebody I use regular? And I think the answer is we haven't seen guidance on that, but so for now, if you issue them a 1099 MISC showing other income that you can use them, correct?
Yeah, Jim, correct me if I'm wrong, Jim, but I think that's the position we're taking is if you're issuing a 1099, you can include that. You're not really looking into the amount of hours that they're working. If they get a 1099 and they're an independent contractor, you get to include that.
Yeah, I mean, I think it depends on, what you can verify. Like, if you can show that it's going to, independent contractors that are doing the work for you, and that payment is equivalent to like wages, compensation, and not like a business arrangement, then I think, you can put that in and apply on that basis.
So what about like a magazine that is paying writers as independent contractors, but they regularly use the same writers? They use photographers who are independent contractors. They might have graphic designers. So that would typically be that they're going to issue a 1099 to all of those people at the end of the year. I think those are all included, correct? Because you have to be able to pay those people to keep your business, which kind of goes to Mike's point on the contractor. I think we need to resolve that issue offline, and we'll post the answer on that, because I think it's not, there's some of these not clear. But on the writers, photographers, graphic designers, whether it's like a lot of, marketing, advertising agencies will also use employees like that, where they're having contractors. If you're giving a 1099, we're saying yes, correct?
If it's part of your, if it's part of your business enterprise, and you're paying them as if you were paying compensation to an employee, and they will look to that as payroll costs, the way it's drafted, and be flexible about that.
And so a question on one of the examples on the slides is that it says the non-forgiven PPP interest is 0.05%. Is that referring to, what is that referring to? 0.5% or 5%?
It's 0.5%, or for the 2-year period, so it's almost interest-free.
Okay, great. So again, what happens to the PPP that is not forgiven? So that has to be paid back at the 0.5%. It's 0.5% annually. Jim, is that what that number is?
0.5%.
Correct.
Okay, I just wanted to make sure, given that was the question. And then can you use the PPP for expenses that are not eligible to be forgiven? So you take out the maximum amount of loan that you get and you don't hire your people back. What happens?
Then any amount that isn't qualified for forgiveness is repaid over 2 years. There's no prepayment penalty. So you just pay it back on the schedule with the bank over the 2-year period.
But I'm not going to get thrown in jail or anything. So if I take out the PPP and it just doesn't work out for me to rehire any employees whatsoever, so my ratio is 0 for forgiveness, but I paid rent and I paid my computer vendors and basically kept everything in place to keep my business alive, paid all the other expenses, that's okay. I just have to repay the entire loan over 2 years at this very low interest rate.
That's correct.
Okay, so I'm not going to get in trouble or anything. Not that there's anybody who's going to be able to enforce or police this at the moment. It kind of concerns me. So, okay. So let's talk about a couple other questions. Refinancing, we've really kind of covered that, I think, correct? What are the advantages of doing the disaster loan?
The disaster loan is going to be helpful. For one thing, it has the potential for the $10,000 immediate advance, which does not need to be repaid. If you get both loans, the $10,000 will be subtracted from the forgivable part of your paycheck loan, but it doesn't have to be repaid. If you've got a longer horizon than just the 8 weeks, so if it looks like your business is going to take more than 8 weeks to get back on its feet, then the disaster loan is going to make sense. And obviously, if you've got a lot of costs that are not going to fit under the forgivable portion of the PPP loan, then the disaster loan gives you access to that credit with a fairly long term and a low interest rate. So
with the exception that it's a smaller amount you can borrow. So if you borrow the PPP, even if you're kind of knowing that, hey, I might have to repay it, but you have over 2 years, it's a super low interest rate, right? So again, it might be, and that's what we're covering when we're doing our consultations, is what's the best option to you. And as much as I know they're worried about funds availability, I'd still be inclined for a lot of employers to be suggesting that they do the disaster loan first and look at doing the paycheck loan in all or closer to rehiring employees. But it's really an depends. What we were getting to ask a lot of questions, is there anything like, if I don't want to do the PPP, does it make sense for me? I'm never rehiring anybody. I don't even know if I'm going to reopen. And for some of the things for the over 500 employers, we're getting a lot of questions on those. So we're just going to cover just some of the other options that are available. And so Mike, were you jumping into that?
Yeah, let's take a look first at the employee, the retention credit. So what this allows, Mary, I think it's slide 20.
Yep, I got it.
Yep. So for certain employers, you can basically get a credit, a payroll tax credit for 50% of the wages that you pay during any quarter where there's a COVID-related crisis. So the first question is, who is an eligible employer? And those are employers whose operations were either fully or partially suspended during any calendar quarter in 2020, or your gross receipts declined by more than 50% when you compare it to the same quarter last year. So if you've had a more than 50% decline, or you were partially or wholly suspended, then you're an employer that may be able to take advantage of this tax credit.
So, and I maybe unfairly asked this question about 2 minutes before we are getting started, so I don't know if you have an answer to it or not yet. But so this like 50%, and this is because a lot of the calls that I'm doing with our consults are those, again, who, hey, we're still working, but nobody's paying us. So is that revenues, cash basis, or is it going to depend on the type of taxpayer you are? If we're actually sending bills, but nobody's paying us,
right,
has our revenue declined by more than 50%? So let's just say the example is we sent the exact same amount of bills this month as we did last month, but the difference is everybody paid us last month and nobody paid us this month.
I believe the answer to that, again, if you look at it, it specifically refers to gross receipts. So in my mind, that is what you have walking in the door. And that would be consistent with the intent, which is, it's the cash that matters right now. So if you don't have the cash walking in the door, then they want you to be able to take advantage of they want you to be able to take advantage of the credit. So in my mind, that's what gross receipts means, is what you get walking in the door. So if I build the same amount this quarter as I did last quarter, but I'm not collecting any money, then to me that's that would be used toward your 50% drop.
And so, and did you already clarify this 100, more than 100, fewer than 100 item?
No. So once you're a qualified employer, then the amount that the credit is based on, then you got to figure out what your qualified wages are. So if you're a qualified employer, then you got to figure out what your qualified wages are. And to figure out your qualified wages, that depends on whether you have more than 100 full-time employees or less. So if you have more than 100 full-time employees, the qualified wages are only those wages that you paid to employees when they are not providing services due to the COVID situation in either one or that we just went through. So if you're over 100, it's only wages that you're paying to employees when they're not providing the services. If you're under 100, then those wages, anything that you're paying to an employee, whether they're there or not, if it's just whatever wage you're paying during that period, that's going to qualify.
And so who does this make sense for?
Well, mostly it's probably going to make the most sense for employers that don't qualify for any of the PPP loan or the disaster loan because they're over 500. You know, presumably they're going to have a bigger, you know, they're going to have a bigger wage amount that they're paying, and then this credit may be something that is more appealing to them than say getting the loan.
And there's a cap on the credit, correct?
Yeah, the cap on the credit is, it's basically, so again, the credit is equal to 50% of the weight of the qualified wages that you pay, but the qualified wages for any individual is capped at $10,000. So really you're talking about a $5,000 credit per employee.
Wait, so I thought the credit's capped at 10 of comp. Okay, I get it. Okay, and so then there's this other option to delay payment of the employer share of Social Security taxes.
Right.
How does that work?
Yeah, let me go back to the retention credit for just one more important point. If you do get a PPP or disaster loan, you're not eligible to take the credit. So
if you get either one of those loans, you're not eligible for this credit.
Correct.
So
That's
for
correct.
most of our under 500 that are applying for one or the other,
Right.
this won't make sense. Okay,
Right.
great.
All right, then on the deferral, what you can do is if you so the 6.2% that the employer pays of the employment taxes, the FICA, you can defer that from, I think it was March 15th through the end of the year. You can defer that 6.2% that the employer is paying. You can defer that for what you would do is if you do the deferral, you pay half of it in 2021 and then the other half in 2022. So it's a deferral basically of the 6.2% that you would otherwise be paying. And again, on this one, if you have a loan that is forgiven, so it's not just that you have it, but if you have a loan, a PPP that's been forgiven, then you're not able to take the deferral.
So I can get a hardship loan, the disaster loan, and I can still defer payroll taxes.
That's correct.
So for those that it doesn't make any sense for whatever reason to get a PPP for, they should be deferring their payroll taxes, the employer payroll taxes.
They should at least be taking advantage of the deferral, right?
Right, and because that gives you some cash flow. So again,
Right.
I keep hearing reports from business after business that even though they're open and operating, they're not getting paid.
Right.
Okay, the big one that we think is kind of cool and an easy way to get cash, it doesn't require you to go through an app, you can just amend a tax return, is the net operating loss.
Right. So back before 2018, you used to be able to carry back an NOL, a net operating loss. You could carry that back for 2 years, and then you could carry it forward after that. That changed with the TCJA. Now, the TCJA eliminated that ability to carry back, and it said you could only carry it forward. And when you do carry it forward, you can't zero out your net income. You can only use it again, or your taxable income. You can only use it up to 80% of your taxable income. With the new recovery package or the new relief package, anything that any NOL that you had in 2018, 2019, or 2020, you can carry back 5 years. So if you have any NOLs in those years, you can now carry those back, and you can get a refund of any taxes that you paid resulting from that carryback. So and there's no 80% limitation. So you can if you paid tax in 2017, if you had taxable income in 2017 that you'd pay tax on, you can use an NOL, wipe out that all that taxable income and get a complete refund of the tax that you paid.
And so
that
that works for both small employer, big employer, anybody that has an NOL that they couldn't carry back. And the advantage is you can get a quick refund and again, enhance your cash flow. I just did have two other questions. I have a question on our consult. So I'm just going to clarify what those are. We are doing like just flat fee consults to try and take some of these principles. And we have, and how you can do those, which was the question, is on our webpage, which is at vwattys.com. And I think it's all over our materials. But you can go to our COVID page and you can just click on there. What we did is we put some inputs so we could try and make that affordable for employers who want to have a consult, is if you gather up this information, put it in, and then we try and talk you through which of these options are going to be best for you. So that's the easy way to do that. And then the slides, yes, they will be available for download. They will be on our COVID website. So again, vwattys.com. There's a big red button you can click to just go to our page. And the other question is, how quickly will these funds be available? When do you get the money if you apply tomorrow? Jim, do you know the answer to that question?
It depends on for the triple P, it depends on the bank. The bank will be responsible, the financial institution, because it includes credit unions and whatever, will be responsible for processing that application and getting the money out. The disaster loans are running through the SBA. They have said they will process them quickly and get the money out, but we'll just have to see, because that's going to be an unprecedented volume for that agency to process that many loans all at once. So
we should all be working for the SBA or the IRS, right? So for the unemployed workers, there's grocery stores, and I was thinking as we were talking this through, what I'd like to be a tech person designing the processing software for the IRS. So Mike, a modification on the limitation of losses for taxpayers? We lost your mic again.
Mike's muted, I think.
Sorry. So one of the other things that the TCJA did was you're talking about the bonus depreciation, right, Mary?
Correct.
So one of the ideas of the TCJA was to increase the availability of 100% bonus depreciation, and there was a class of a property that inadvertently got excluded from the ability to take that bonus depreciation, and it was just a technical glitch, really. But what they did was they corrected that technical glitch, so now you're able to take that property that used to be unable to have the bonus depreciation. You can now get the full bonus depreciation on it. So you can actually go back and amend returns to take the full bonus depreciation, which again could result in a refund for you.
And of course, I really didn't do it on purpose though. Messed you up and didn't give you the right slide for what you're asking. But so then the next one is the modification of the credit. But see, you did well without your slides, so that's really good. You know your stuff. So the modification of the credit for prior year minimum tax, can you tell us what that's about?
Yeah, so one of the things that the TCJA did was it repealed the alternative minimum tax for corporations. Well, if you were a corporation and you had AMT credits that you were trying to carry forward, if the AMT tax is now gone, you got nothing to use those credits against. So what the TCJA did was it allowed you to use those credits, and you could get them refunded in 2018 through 2021. It's basically a 50% declining calculation, but that's how you could get the credit repaid, so to speak. What the Relief Act did is just said basically, hey, if you've got some unused AMT credit, you can just use that all right now, and get a refund for it.
The business interest provisions?
So the business interest provision, one of the things that TCJA did was limit the amount of interest expense that a corporation could take to 30% of the 30% of the corporation's adjusted taxable income. So what the Relief Act did, it increased the limitation to 50% of your adjusted taxable income for 2019 and for 2020. What it also did was for 2020, because if your taxable income might go down because of the crisis, it allows you to use your 2019 income to figure out what your 2020 limitation is. So it allows you to apply the 50% to a bigger number, so you'll have a greater deduction.
So is this one of those where if somebody's already filed their 19 returns, there might be an opportunity to amend or not?
Yeah, I mean, if you were basing your 19 return on the 30%, you can now have an increased deduction of up to 50%. So yeah.
So there's a lot of who ought to take a quick look at, hey, I filed my 19 really quickly, but maybe we should revisit that. I might have a refund check coming. That's generally kind of, for almost all business returns, there's enough provisions that should at least be a conversation that you have.
Right.
And then this is the one that I didn't give you the slide when you were covering it. So let's just move on. There's a temporary, we love this one, the exception from excise tax for alcohol to produce hand sanitizer, right?
Yep.
And then the charitable contributions, you want to speak to that?
Yeah, so normally if you're not itemizing, your charitable contributions don't do much for you. So what the Relief Act did was said, hey, if you make a $300, up to $300 of cash contribution, whether you itemize or not, you can take an above the line deduction. You're just going to get a $300 deduction.
So just a little bit of help there, right?
Yep. Yep.
And so then exclusion for a certain employer. So the student loan provisions, what's that doing?
So right now, if an employee pays, if an employee can basically pay up to $5,250 in educational assistance to an employee, and that's non-taxable. That's non-taxable to the employee. If what the Relief Act did was, well, I should back up. Prior to that, payment of principal and interest by the employer on a student loan was not considered an educational, was not one of the expenses that could be covered. What the Relief Act did is just simply said that now principal or interest that you're paying on a student loan is covered cap. So, but instead of paying room and board or something like that, or books or fees, you could repay student loan up to $5,550, and then that would be covered.
And then there's a few other ways that employers can help to employees actually access some money, or people have IRAs or retirement accounts. So right now they can take penalty normally if you're under 59 and a half, unless you qualify for an exception. There's a penalty on early withdrawals. Right now you can take an early withdrawal penalty free, and if you're able to repay it, then you can repay it over like 3 years, and you can ultimately do it on a tax-free basis. To the extent somebody has a retirement plan, like an employer has a plan, they can amend that. They don't have to do it today, but by the end of 2020. But as today, they could let people take loans of up to 50% or 100% of the value. Historically, that's been limited to 50% or 50,000. Now it's 100%. And there's some documents, and I think Jim's our expert on that piece, in terms of just getting the loan documents that you need to let an employee take that loan. You don't have to amend the plan till the end of the year, but if you want to let employees access that, you can go ahead and do that right away. So those can be adopted. The other thing is for that, because the market's been really interesting by the day, I'm trying to ignore it. The minimum distributions, to the extent somebody's required to take an amount out historically, so that amount would be calculated based on December 31, 2019 value, when everybody looked amazing, and you would divide that by your life expectancy. So now you have to take that big amount and pay tax on it out of an account that may be diminished substantially. So minimum required distributions are waived for 2020. So you can just not take that. And then who was speaking to that increased threshold for the small business bankruptcy reorgs? Was that Alex or Mike?
I think that was Alex.
Alex, are you still there?
Yeah, I am. Yeah, so the small business, so So last fall, they passed a law that essentially allowed for a streamlined process for bankruptcy reorganization, essentially just using the federal bankruptcy laws to reorganize debt so that way it can be manageable and be paid in a scheduled manner that the business can absorb. The CARES Act actually made a useful provision where they actually increased the threshold. So it went from about $2.7 million up to $7.5 million in terms of the amount of debt that's owed. So for small businesses that have debt and they need to reorganize it in order to emerge from the current situation, this is a tool where they can go in. It's a more streamlined, more cost-efficient method. Obviously not ideal to enter bankruptcy, but if you are forced to use the tools afforded there, this is a more streamlined and cost-efficient method, and it's more widely available at this point.
And one of the things you're doing a lot with employers, so I mean, the primary, everybody's worried about getting these loans, but there are a lot of other strategies to look at, right? And so some of that is the restructure, reorganization. We're doing a lot of renegotiating leases and contracts and all kinds of things like that. And we're seeing in some places, I've had, some landlords say no tough, and but for the most part, we've had, people are saying, hey, we're hoping to keep you as a tenant afterwards, or we're hoping to, and just realizing that what's going on. So I think you're doing a lot of that. If there's anything else you want to comment on that you're seeing that's helpful to businesses trying to continue to function in some fashion.
Yeah, I mean, obviously in the short term, the most important thing is making those quality business decisions and trying to make sure that you have the room, the run rate to survive the next, 8, 10 weeks or whatever it is to get to the point where you are having revenue that exceeds your expenses again. So right now that's, renegotiating contracts, talking to suppliers, talking to people that, owe you money, that's come up a couple times, and renegotiating a lot of those contracts. And fortunately, a lot of people are all kind of in the same boat where, they kind of, to your point earlier, are very helpful and trying to be helpful. But, the earlier we can renegotiate a lot of those, current debt, contracts, the better it is, just because, if this lingers, I think people will be in less of a place to help people, including banks and current lenders.
So a great question I have is and I'm just going back to the waiver of the required minimum distribution, is whether you can put it back in if you took it out already. And I'm just going to admit that I don't know the answer to that question, so I'll follow up with it on our website. But Mike, did you know that one? Can you put that? I know you can, if you take out a distribution, generally you can, but if you've taken the RMDs wavered, so the early distribution, we have the penalty exception. If you don't know, I'll just follow up on the website. Great question.
Yeah, I'm not sure.
Okay, I'll follow up on that. One thing I'm going to back up to you, Jim, with this question is, once you apply for one or both programs, and I believe we're referring back to the hardship loans or the PPP, what is the next step? Who contacts you? And I think easy clarification is the hardship loan, you apply for that online to the SBA, and then for the PPP, you're applying to a bank. Is there anything else you want to clarify or add that? So the particular question posted is, my bank was confused and sent me to the SBA, which makes me wonder if that bank is one of the participating banks. And there is a list of participating banks currently available on the website for these loans. And we'll have that, if we don't have that posted on our website right now, we will have that posted so that you can find the list of approved banks.
Yes, there's a link to that in the article on the PPP loans. Yesterday, it wasn't actually taking you to the list, but they may have that corrected. But yes, the SBA is supposed to be directing people to an appropriate lender, an authorized lender, if you don't already have one that you have a relationship with. But
so, and the bank that was identified, which I'll leave unnamed, but is a really major international bank, I think, aren't they running most of these through like local community banks?
yeah, I mean, the the people that do the SBA, the people that are already authorized are people that traditionally would be doing the SBA 7A loans, which are the common loans for small business people. The Treasury is trying to ramp up, adding as many additional lenders as they can. And they say they're making progress on that process, but you just have to check with each particular financial institution to see whether they're authorized to participate yet or not.
And so here's a really great question. Does anyone know of anyone who actually received funding from the disaster loan yet? Alex, if any of you are you've been doing a lot of the consultation calls. Has anybody actually gotten cash yet?
I have not heard of anyone who's actually received cash yet. Most people are still within most people are right on the edge of that 3-day window that they initially targeted for the grant part of the disaster loans, but I haven't heard anyone actually get funded yet.
So it'd be nice if we should be having people who have applied be getting at least that $10,000 emergency grant. But yeah, I have not talked to anybody who's actually gotten a check yet either. So if anybody else has, we're interested in knowing. There's a question here as to whether there'll be a Q&A available. So we did assemble all the Q&As we're assembling those from our various webinars, and those will be posted on our COVID website. And so the answer to that's yes. And then somebody else is asking, well, we've applied, but we've heard nothing from the SBA, not even a confirmation email. And that is what I'm hearing commonly is, so when you apply, supposedly though, a number pops up on your screen. So hopefully screen capture, write down some way, capture that number. But I don't know, Jim, is there like, if somebody wants to follow up to make sure, because I haven't heard of anybody actually getting a confirmation email. Is there a way,
Yeah.
Is there anywhere that we know of to log in and check on the status of the loan app?
I have not seen that yet, but again, this is an unprecedented level of administration for that agency, so it might take them some time to ramp up to get this working, but yeah, we'll try to. I mean, all you can do is just keep following up, and we'll try to follow up with people.
Yeah, so I've had several people pop in and say they got the confirmation number, so that's kind of, but here's what I know in terms of having worked with government entities, trying to get their system structured to demand these, it's not an easy task, right? Even though they're lifting a lot of regulations. So let's hope that they've got some really good tech people. Otherwise, again, there's a great job for anybody who's unemployed is to get out there. So the hope is, you know, they've said those 10,000 emergency funds were going to be within 3 days of application. I haven't heard of any yet. And if anybody gets theirs that's on this call, hey, let us know, because we kind of like to know some people are seeing some funds. I just have a couple last questions. Anyway, we got to thank you. So yep, thank you for listening. And we're sorry everybody's going through this. This is really an incredible life moment. And as a person who's been taking these calls the last few weeks, I can tell you, I just want to cry every time I hang up from talking to somebody. And just, but we're going to find our way through this, and that's what we're trying to help with. One thing is, how do you not apply for the PPP loan if we have no idea? That's a really good question. So I think the question is, how do you, if you're applying for the PP loan, and I think the question that I saw in the application was, have you received funds from the disaster loan? And so the answer to that is no, if you haven't. I don't recall it asking whether you've actually applied. So the concern being, hey, how do we balance out those two applications? So my response to that is the way the question reads, it says, have you received funds? If the answer is no, just say no. So thanks very much to all of our listeners. Feel free to send follow-up questions. And again, if it's of any value to you, we are doing the consultations. We're doing a flat fee because we know cost is a concern for everybody. And to facilitate that, we have an input sheet where you give us information so we can kind of keep that process efficient. We are having a webinar, and does any of you guys remember the date on some of the employment issues? So one of the big things for employers is that all of a sudden we all thought we're going to have remote workers for 2 weeks, and now we're looking at 6 weeks, and who knows, maybe longer. And so a lot of people are finding the challenges of the challenges of managing the remote workforce and all of those things. So we're going to cover those issues as well. We're also going to cover some estate and tax planning issues. There's actually really some opportunities there. I did have another question pop in on working across state lines. And what I will tell you is I think the question is whether we do, and we're licensed in several states. Base of operation doesn't matter, competency does. So feel free to let me know. But we provide services pretty much across the country. And no state taxes. That's a lovely state to be in. So I was just reading the comment. So we like to do work in states with no state taxes. Those are great states. We actually do have a license in Florida, by the way. So love that state. Additional questions that pop up, we will follow up with the Q&As that we'll post online. Again, thanks everybody for participating and hang in there and stay well.
Thanks, everybody.
Yeah, it's April 7th is the webinar on the remote work policy.
And thanks, Jim.
Thanks.